Hello everyone. In this video, let's learn about hostile takeover. A hostile takeover is the acquisition of one company called the target company by another called the acquirer, that is accomplished by going directly to the company's shareholders or fighting to replace management to get the acquisition approved. The, ta- the key characteristics of a hostile takeover is that the target company's management does not want the deal to go through. Sometimes a company's management will defend against unwanted hostile takeovers by using several controversial strategies such as the poison pill, the crown jewel defense, or the Pac-Man defense. When a company buys another company, it can be considered as merger or acquisition. When this merger or acquisition takes place without the consent of target company, we can call it as hostile takeover. For example, A company is willing to buy B company, but B is not ready for this deal. Therefore, A company is forcefully buying the B company without their consent. It becomes hostile takeover. Since the management of this target company is not ready for this hostile takeover, they try to defend themselves by using certain strategies, and they can be considered as poison pill strategy, crown jewel strategy, or Pac-Man strategy, and thereby they are trying to protect themselves against this hostile takeover. How is a hostile takeover accomplished? There are three common methods. Here, a acquiring company can use three methods by which they can take over the target company, and these three methods are as follows. First one, hostile bid. Company A wants to achieve a hostile takeover of company B. Company A goes directly to the shareholders of company B with an offer to buy their stock at a premium price substantially above the current market price. This is known as making a tender offer, and if successful, company A takes majority ownership of company B even if the board of company B objects. As you all know, equity shareholders are considered as the owners of companies. Here they hold the voting rights. Here under hostile bid or tender offer method, company A, or else we can say the acquiring company, instead of going to the management of company B, directly goes to the shareholders of company B. They are offering higher prices for the securities held by these shareholders, and thereby tempting them to sell the securities to company A. If the shareholders are if the shareholders of company B are ready to sell their securities to company A, automatically the company A becomes majority shareholder, and thereby they hold the majority voting rights, and automatically they become the owners of this company B even if company B is not ready for this deal. That is the first method, hostile bid, offering higher prices for the securities of target company's shareholders. Here they are offering these higher prices directly to the shareholders, not to the board of management of this company B. Second one, open market. Company A buys a majority of the available shares of company B on the open market, thus taking control of company B. This may not always be possible, as majority of the shares may be in the hands of private investors and the not holdings of the financial institutions available for purchases. Here, instead of going to the shareholders, the acquiring company is trying to buy majority of the shares of target company in the open market itself, that is in the stock exchange itself. Here they are trying to buy majority of the shares under open market, but this is not that easy method, because majority of the share will be held by the private individuals, not by the financial institutions. Therefore, it is a little difficult method for acquiring company to buy majority of the shares in the open market. They are not visiting any shareholder directly, rather they are trying to buy majority shares in the open market itself, that is open market method. Proxy fight. Shareholders in a company have a right to vote on things like replacing management or selling the company. Then they can either vote on their own behalf or assign their voting rights to someone else through a form called proxy. A proxy fight is when an acquiring company convinces shareholders of a target company to assign them their voting rights through the proxy. The acquiring company then uses the proxy votes to boot out the management who oppose the takeover taking control. Proxy is like an agent who acts on behalf of their clients. Here, as you all know, the equity shareholders they hold the voting rights and they can use these voting rights either for replacing the management or even for selling the company. These shareholders they can use their voting rights on their own or they can also give it to someone else. If they are giving it to someone else, the other person becomes proxy. Here under proxy fight method, acquiring company is convincing the shareholders to give their voting rights to their proxies and making the proxy vote against the management of the company who are not ready for this deal. It is called proxy fight. By inducing the shareholders to give their voting rights to the proxy and making the proxy vote against the management of the target company, a acquiring company can take over the target company. That is proxy fight method. These are the three ways in which a company can an acquiring company can acquire the target company. The three methods are hostile bid, going directly to the shareholders of the target company; open market, that is buying majority shares in the open market; or proxy fight, inducing the proxy to vote against the management of the target company. Defensive strategies. There are several hostile takeover defense strategies that target companies can use to prevent unwanted acquisitions. Here, the target company can use several strategies to protect themselves against the hostile takeover, and they are as follows. First one, poison pill. The poison pill strategy aims to make takeover expensive enough to deter buyers. It's officially known as shareholders' rights plan and allows current shareholders or stakeholders to purchase new shares at discounted price. The plan excludes the hostile bidders from the discounted price, making it difficult for the buyer to obtain a controlling share without a steep cost. Poison pill strategy, it is a strategy which is used to make takeover more expensive, making the takeover more costlier. Here the target company offering shares to the existing shareholders at a discounted price. Under tender offer strategy, we have seen the acquiring company directly approaches the existing shareholders offering higher prices for their share and thereby buying the majority voting rights. Under poison pill strategy, the targeting company trying to make this tender offer more costlier because the existing shareholders will hold majority shares. At the same time, the companies, this acquiring company, they may have to pay very high prices in order to buy the shares from the existing shareholders. That is the idea behind poison pill strategy, making the takeover more costlier. Differential voting rights. The preemptive defense strategy involves establishing stocks with differential voting rights, meaning shareholders have fewer voting rights than the management. If the shareholders must own more shares, cast votes, a takeover becomes more costly endeavor. Here, the company issuing shares with different voting rights, keeping majority voting rights with the management itself. When the majority voting rights is there with the management itself, they can avoid this kind of hostile takeover. Even if the acquiring company wants to buy shares of this target company, they may have to pay higher prices for these shares. It is a differential voting rights strategy. Employee stock ownership program. Another preemptive defense strategy is to create a tax qualified plan that grants employees more substantial interest in the company. The idea is that employees are more likely to vote for the management rather than support the hostile buyer. Employees are very essential for every company. If the company treats their employees well, the employees will protect their company against all the odds from the outsiders. Here, under employee stock ownership program, the company is trying to treat their employees well, that is by offering different plans which is going to benefit them in the long run, and thereby making sure that these employees will not vote against their management when hostile takeover situation arises. Next one is Pac-Man defense. Target companies may choose to avoid hostile takeover by buying stocks in the prospective buyer's company, thus attempting a takeover of their own. As a counter strategy, the Pac-Man defense works best when the companies are of similar size. It is more like a counter attack strategy, or else we can say a proactive strategy adopted by the target company. Here, this target company will not let the acquiring company purchase their shares even before the acquiring company thinks about purchasing the shares of this target company. The target company buys the shares of acquiring company, and thereby avoiding the acquiring company to take over their business. That is a Pac-Man defense. It is possible for those companies which are of same size. Next is crown jewel. Employing a crown jewel defense means selling the company's most profitable assets, reducing its attractiveness to unwanted buyers. This is risky strategy as it destroys the company's value. As such, many companies will seek a friendly third party company, often referred to as a white knight, to buy their assets. Once the hostile buyer drops the bid, the target company can buy the assets back from the strategically chosen third party. Crown jewel. Here, this hostile takeover usually takes place mainly because the acquiring company finds certain assets of the target company attractive, and they think that these assets of the target company will help them in the long run. To discourage the acquiring company taking over their company, this target company is selling their most profitable assets to a third party called white knight. It takes place as per the agreement between the target company and the white knight. Once the acquiring company drops the idea of taking over the target company, the target company will buy back the assets from the white knight. It is a risky strategy, but still a method used to make the takeover less attractive for the acquiring company. One of the method used to avoid this hostile takeover. These are the different methods used to defend themselves against the hostile takeover for targeting company. The methods are poison pill, that is making the hostile takeover more costlier, that is by offering shares to their existing shareholders at a discounted price. Differential voting rights, issuing shares with the differential voting rights, keeping majority voting rights with the management itself. Employees stock ownership program, that is a method of treating their employees well and making sure that they won't vote against their company. Pac-Man defense, a proactive method, not letting the opponent act and buying the shares of the acquiring company itself. Crown jewel method, selling the most attractive assets of the target company and thereby making the takeover less attractive for the acquiring company. These are the different methods used. These are the different methods that can be used by the target company to make hostile takeover less attractive for the acquiring company. Here, this hostile takeover method takes place against the wish of the management of the target company. Usually, under takeover or merger, both the companies are agreeing to the proposals, then we can say it is more ethical. But under hostile takeover, the process occurs without the consent of the management of existing company. Therefore, we can say it is more likely unethical method. That is all about hostile takeover. Thank you.